Stop trading. Seriously, stop right now. Because every single move you've made today has been exactly what the market makers wanted you to do. You're not a trader, you're a line item on their balance sheet. And if you don't hear the next 3 minutes, you're never going to survive in this game. Everything you know about trading is a lie. Let that sink in. Strip away the noise. Erase every indicator, every textbook pattern, every comforting piece of advice handed down by gurus, brokers, and self-proclaimed masters who have never smelled the genuine sulfur of real market annihilation. You were lied to. You were given a map drawn by people who have never walked the territory. You were handed a compass that spins wildly out of control the moment the tempest hits. You were taught to look at the markets through a lens of certainty, predictability, and control, when the market, in its absolute raw essence, is a living, breathing predator designed for one singular purpose: to hunt down your assumptions and slaughter them. Look at your charts. Go ahead. Pull up the glowing screens that consume your nights and steal your peace. What do you see? Support and resistance lines? Moving average crossovers? Fibonacci retracements that look more like modern art than mathematical truth? Stochastic oscillators telling you when an asset is overbought or oversold? It is all a comforting illusion. It is a pacifier handed to children sitting in the cockpit of a supersonic jet. The retail trading industry does not want you to succeed. Let's speak the unspoken truth. The entire ecosystem, from flashy online academies to algorithmic market makers, survives on your perpetual delusion. They sell you the dream of mechanical perfection because a predictable system keeps you trading, keeps you paying commissions, keeps you feeding liquidity into the gaping maw of institutional capital. They taught you to treat the market like a science. It is not a science. They taught you to treat it like a puzzle to be solved. It is not a puzzle. The market is a battlefield. It is an arena of raw, unfiltered human psychology, where fear and greed clash in an endless bloody war. And if you enter that arena armed with retail folklore and a 3-line moving average, you aren't a trader. You are ammunition. Today, we are going to burn the old playbooks to ashes. We are going to strip away the comforting lies and stare directly into the naked face of market reality. If you want to survive, if you want to stand among the razor-thin percentage of individuals who consistently extract wealth from the jaws of volatility, you must unlearn everything. Every single rule you hold dear, every habit that bleeds your account, every excuse you whisper to yourself when the margin call arrives. Welcome to the demolition. Let us dissect how they broke your mind, how they systematically programmed you to fail before you even placed your very first order. It begins with the myth of certainty. Human beings are hardwired to crave order. We despise chaos. When we look at a chaotic price chart, our brains desperately search for patterns, symmetry, and meaning. We want the world to make sense. We want to draw a neat little trend line, touch it 3 times, and say with absolute conviction, here. This is where the bounce happens. The market doesn't care about your need for order. The market is pure, unadulterated chaos, dressed up in numbers. When you draw a support line, you aren't identifying a magical floor built of steel. You are drawing a line directly across a massive pool of pending retail stop-loss orders and resting liquidity. Think about that. Let it burn into your consciousness. What is a support level to a retail trader? To you, it is a fortress. It is a sign that reads, buyers are here. Defend the line. To an institutional algorithm, to a market maker managing billions of dollars, your support level is not a fortress. It is a target. It is a neon sign flashing across the dark pool liquidity network that reads, billions of dollars in weak hand stop losses are clustered right here. Come and take them. This is why your stops are constantly hunted. This is why the exact millisecond you enter a trade because a candlestick pattern looked bullish, the market violently reverses, spikes through your stop loss with terrifying precision, and then rockets in the direction you originally predicted. Was it bad luck? Were the market makers personally plotting against your $2,000 account? Don't flatter yourself. You weren't targeted out of malice, you were swept away out of mathematical necessity. Your predictable behavior made you statistical fodder. You traded textbook patterns, and the institutions who wrote the textbooks know every single page by heart. Let's look at the second great lie, the Holy Grail indicator. How many hours have you wasted scrolling through YouTube videos, hunting for the ultimate indicator setting? How many times have you tweaked the MACD, adjusted the RSI parameters, or paid hundreds of dollars for a custom script that promises a 90% win rate? Admit it, we've all done it. We've all fallen for the siren song of automation. We want a magic formula that tells us buy here, sell there, collect profits, repeat. Here is the brutal, undeniable reality. Every single indicator is mathematically derivative. Every indicator is a lagging ghost of price action. An indicator does not tell you what the market is doing, it tells you what the market already did. Using indicators to predict future price movement is like driving a high-speed vehicle by staring exclusively in the rearview mirror. You aren't navigating, you are memorizing wreckage. When you rely on indicators, you outsource your thinking. You surrender your intuition to a mathematical formula designed in the 1970s for paper and pencil charting. You become reactive instead of proactive. And in the financial markets, if you are reacting, you are already dead. Now, let us turn our weapons toward the sacred cows of trading education. Let's talk about risk management and win rates. Every guru loves to preach, cut your losses short, let your winners run. It sounds wonderful, doesn't it? It sounds like the kind of sensible, disciplined advice your grandfather would give you over Sunday dinner. It looks fantastic printed on a motivational poster. Yet for 95% of retail traders, this advice is completely useless. Why? Because knowing that you must cut your losses and how to actually execute it under the psychological torture of an active drawdown are two entirely different universes. Tell me if this sounds familiar. You enter a trade. The market immediately moves against you. Your internal alarm bells start ringing. Your heart rate spikes. Sweat beads on your forehead. You stare at the profit and loss column ticking deeper and deeper into the red. What does the textbook say? Cut it. Accept the small loss. What does your human brain do? Your brain panics. Your brain refuses to accept defeat. Your ego screams, no, the market has to turn around. It can't go any lower. If I close this now, I lock in failure. If I hold on, there's a chance it comes back to break even. So what do? You move your stop loss further away. Or worse, you remove it entirely. You pray to whatever gods will listen. You watch your account bleed until the platform makes the decision for you via a brutal, unforgiving margin call. You didn't fail because you didn't know risk management. You failed because you underestimated the sheer, brutal weight of human emotion when money is on the line. Information is cheap. Discipline is forged in the fires of psychological agony. And then, we have the ultimate obsession of the amateur mind, the win rate. Open any social media trading group, and what do you see? Screenshots of 90% win rates. Flawless equity curves climbing straight up to the heavens. People bragging about winning 10 trades in a row. And what happens to you? You look at your own account, where you might have a 40% or 50% win rate, and you feel like a failure. You think you need to find a strategy that never loses. Listen to me very carefully, and let these words echo in your soul. The win rate is the single most deceptive, toxic metric in the entire universe of trading. You can have a 95% win rate and still go completely bankrupt in a single afternoon. How? Simple. You risk $10,000 to make $100. You win 9 trades in a row, feeling like an absolute genius gathering pennies in front of a steamroller. Then, on the 10th trade, the market violently trends against your unhedged position, wipes out all your accumulated gains, and shatters your entire account equity. That is not trading. That is financial Russian roulette with a fully loaded cylinder. Conversely, the greatest traders in history, legends like Jesse Livermore, Paul Tudor Jones, and institutional risk architects, frequently operate with win rates hovering between 35% and 45%.
Let that sink in. They are wrong more than half the time.
They lose trades constantly. Day after day, week after week, they take small losses. They accept being wrong. So how do they amass legendary fortunes? Asymmetry. When they lose a drop of blood. When they win, they capture an ocean. Their risk-to-reward ratio is so violently skewed in their favor that a single massive trend-following trade pays for 10 small failures and leaves millions left over in pure profit. You don't need a high win rate. You need the courage to lose correctly, and the patience to stay in the game until the asymmetric monster setup finally presents itself. If everything you know is wrong, if indicators are ghosts, support lines are traps, and win rates are illusions, what is left? What separates the blood-soaked wreckage of the 95% from the untouchable elite of the 5%? It is not a system. It is not an algorithm. It is state of mind. It is psychological sovereignty. To trade at the highest level, you must undergo a complete psychological death and rebirth. You must strip away your ego, your need to be right, your desire for social validation, and your emotional attachment to money. Let's talk about the ego, because the ego is the silent assassin in your trading account. Why do you hold on to losing trades? Ego. You cannot bear the thought of admitting you were wrong. Why do you revenge trade after a massive loss? Ego. The market humiliated you, and your wounded pride demands immediate vengeance. You jump right back into the lion's den with triple the leverage, angry, desperate, and blind. The market does not know your name. The market does not care about your pride. The market does not owe you a single cent to make up for your rent, your bills, or your bruised ego. When you fight the market, you are fighting gravity. You are standing in the middle of a railway track, shaking your fist at an oncoming freight train, screaming, "Turn around! You're going the wrong way!" The train will not turn around. It will crush you into dust without slowing down. An apex predator in the markets does not fight the train. They don't even try to predict every single twist and turn of the tracks. They wait in the shadows, silent and disciplined, until the environment shifts in their absolute favor. And when it does, they strike with terrifying precision and overwhelming force. They master 3 foundational pillars that every amateur completely ignores. First, radical acceptance of uncertainty. Amateurs want guarantees. Professionals embrace probability. An amateur enters a trade and demands that the market validates their analysis. A professional enters a trade knowing full well that anything can happen, and more importantly, knowing that it doesn't matter, because their risk is strictly defined and emotionally detached. When you accept that you cannot control the outcome of any single trade, anxiety vanishes. Fear evaporates. You become free to execute your plan with the cold, unyielding precision of a machine. Second, the elimination of outcome attachment. Your self-worth cannot be tied to your daily P&L. If a losing day sends you into a spiral of depression, rage, or self-doubt, you are not psychologically equipped to trade. Money in a trading account is not your grocery money, your rent money, or your identity. It is simply ammunition. It is inventory in a business. A master carpenter does not weep and smash his workbench when a piece of wood splits. He adjusts his cut, learns from the grain, and uses a new board. Treat your capital like business inventory, not like emotional validation. Third, extreme patience through boredom. Real trading is not an adrenaline-fueled casino game flashing lights every 10 seconds. Real trading is 95% excruciating, mind-numbing boredom, followed by 5% intense, hyper-focused execution. The amateur wants action every single minute. They need the dopamine hit of placing trades, watching candles flicker, and feeling the rush of volatility. If they aren't in a trade, they feel like they are missing out. That FOMO, fear of missing out, is a slaughterhouse. The elite trader can sit on their hands for days, weeks, even months, watching setups form, waiting patiently like a tiger in tall grass. They do not force trades. They let the trades come to them. If no high probability asymmetric setup exists, they close their laptop and walk away. Can you do that? Can you stare at a screen for 8 hours and take 0 trades because the market didn't meet your exact, uncompromising criteria? If the answer is no, you are still playing the game as a tourist. And tourists always leave their wallets behind. So, where do we go from here? How do you tear down the faulty foundation and build a fortress that cannot be breached? You build your edge on 3 unshakable pillars of modern market reality: liquidity, context, and execution. Let's break them down. Pillar 1, liquidity mapping. Stop looking at where retail traders are buying and selling. Start looking at where institutional capital is forced to execute. Institutions manage billions of dollars. They cannot simply click a button and buy $1 billion of an asset without moving the entire price against themselves. They need liquidity. They need massive pools of resting orders to fill their massive positions. Where do those pools live? Above obvious double tops and double bottoms, below major Asian session ranges, at major trendline breaks where thousands of retail stop losses are neatly stacked like firewood. When you learn to read a chart through the lens of liquidity, identifying where resting orders are trapped and where market makers are engineering sweeps, the entire matrix of the market reveals itself. You stop trading the symptom and start trading the cause. You stop fighting the institutions and start riding in the slipstream of their multi-billion-dollar wake. Pillar 2. Macroeconomic and structural context. A technical pattern in a vacuum is meaningless. A double bottom means nothing if the underlying macroeconomic tide, interest rate environment, and global liquidity cycle are violently working against it. You must understand the broader context. What is the central bank doing? Where is capital flowing globally? What is the institutional sentiment across asset classes? When technical execution aligns with macro structural flow, you no longer have a setup. You have a gravitational pull. You have the entire weight of the global financial system pushing your trade in one direction. That is where generational wealth is forged. Pillar 3, the execution matrix and rule-based automation. Your emotions are your worst enemy. Therefore, your trading plan must be so rigid, so mechanical, and so thoroughly back-tested that it removes human hesitation from the equation. You do not decide during a trade whether to exit. You decide before a single cent is risked. If X happens, I execute Y. If Z happens, I cut the trade instantly without a second thought. You treat your trading plan like an airplane pilot treats their pre-flight checklist. A pilot doesn't get halfway down the runway and think, you know what, I don't feel like checking the flaps today, let's just vibe it and see what happens. No. They follow the checklist because deviation equals death. Your trading checklist must be your law. No deviations, no exceptions, no emotional overrides. We have reached the edge of the cliff. Everything you thought you knew has been challenged. The fairy tales of easy indicators, guaranteed win rates, and textbook support lines have been stripped away and left to burn in the fire of reality. Now, you stand at a crossroads. Behind you lies the comfortable lie. You can close this video, go back to your glowing charts, draw your meaningless lines, tweak your lagging indicators, and continue feeding your capital to the institutions who wait for you with open arms. You can keep lying to yourself, blaming bad luck, bad timing, and rigged markets for your failures. Or you can step across the threshold into the brutal, demanding, yet infinitely rewarding world of absolute market mastery. You can accept that the fault was never the market. It was your approach. It was your ego. It was your undisciplined mind. The market is not your enemy. The market is the ultimate mirror. It reflects back to you your deepest insecurities, your lack of discipline, your impatience, and your greed. It exposes every single flaw in your character with mathematical precision and ruthless efficiency. To conquer the market, you must first conquer yourself. Unlearn the noise, erase the garbage. Build your psychological armor. Master liquidity, embrace asymmetric risk, and forge an unyielding discipline that does not bend when the storm hits. The illusion is over. The work begins now. Look at your screens. Are you ready to stop being ammunition and start becoming a master?